My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Okay, my friends, I'm just trying to make a little money. My job, not just to entertain, but to put this crazy market into context. So call me at 1-800-743-CBC or tweet me at Jim Cramer. When you get these kind of rallies, and you get them very rarely, it reminds you that you have to stay in this market to make big money. You can't flit in and flit out. When I say stay in, I mean that you have to be as invested as you possibly can be so you don't miss monster moves like the Russell 2000 up 3.5% today. Well, we always talk about the Dow, which had its own explosion up 743 points to a new record, by the way. S&P 500 up 0.64, also a new record. NASDAQ up just 0.2% thanks to being pulled down by the mega cap tax. But today's market is now being led by some real oddball stocks, specifically non-techs, a totally different kind of rally than what we're used to, when very few people even seem to know about the leaders. Hey, and don't I know it? The biggest winners in the Russell today, since this amazing rally began last week, are all companies I either don't know or that I've barely heard of. And you know, I know thousands of stocks. How's this all possible? What happened to the Magnificent Seven techs? Is it a breather or are they finished? Are we too overbought to get in now? Is it too late? These are important questions we must solve right now. Let's unpack this move and make some sense of it. First, this is an all-eccentric, amazing, really began to... When did this really start? It started when we got that cool consumer price index reading we got last Thursday. No inflation in the month of June. That's what triggered it. That's the first prop of the small cap rally. Most people are surprised to see that lowering of inflation could trigger a gigantic rally among so many small cap stocks. But when you take a look at the ones that are running, almost all are biotechs. And by the way, almost all are losing money. If you look at the top 35 performers, all of which are up more than 35% since in a week, less than a week, including 11 that are up more than 50%, you'll see that roughly half are biotechs and healthcare companies, almost all losing money. Conclusion, this is a market led by the most risky stocks, the Russell 2000 stocks, specifically money-losing companies that might be worth something years from now, but not at this moment. These are exactly the kind of stocks that only thrive when inflation is nil or we're facing deflation. After the CPI showed inflation on the ropes, it makes a ton of sense that these stocks would lead us higher. They're probably not done. Second, while the Russell 2000 may be leading us, there are a ton of stocks that represent what I call small and medium-sized businesses. Now, what do these smaller companies have in common? When I study them, I see many enterprises that benefit from lower interest rates, but I also spy a list of names that have been left behind by the big capitalization stocks. I want to generalize for a moment. I think these stocks are rallying because there's a sense that Trump's going to win the election, and that will mean a rollback in regulations. The theory here is that the big cap outfits can easily negotiate the regulatory landscape, but the small, medium-sized businesses, they can't. They don't have the money or the connections to fight back. Would I want to embrace this thesis? Look, it requires a Trump win, which is not assured, followed by a successful rollback of federal rules. Again, not a given. But I do believe that these smaller companies have been hamstrung by regulation that actually benefits the big dogs because they can handle all the red tape. Small and medium-sized businesses do need to be unfettered for them to have a level playing field. You know what? This market's saying that will happen. Now, third, we know from the legendary Larry Fink, the CEO of BlackRock, that investors increasingly want to take more risk because they're more optimistic about stocks, not about the country, about stocks. This view surprised me given the palpable sense of gloom in America. But the investor base sure isn't gloomy, or they wouldn't be buying so many risky stocks or risky ETFs. The money's coming in from the sidelines, where it had been collecting very high interest, at least relative to the last couple of decades. But now the return you can get from cash isn't as attractive as what you can get from stocks, or it certainly won't be. Considering the huge number of stocks that have rallied, 348 Russell 2000, up 20% in the last 5 days. A staggering 1,262 stocks, up 10% in that same period. Who can blame people seeking a better return than they can for a 5% annual payout that you can get from a certificate of deposit? Fourth, many of the stocks that are flying below the recently down and out home builders, for instance, the retail sectors, they're starting to rally because mortgage rates are coming down, or perhaps maybe because of the retail sales report that we got this morning that was pretty darn good. Even the home-related and healthcare stocks in the Dow Jones Industrial Average roared today. It's as if when we get the CPI reading, the Fed now has a green light to cut rates, maybe again and again, which means you have no choice but to own that kind of stock. Smaller home-related stocks did even better, which makes sense because they're all playing catch-up. Fifth, many of the biggest winners are companies that you might have expected to receive takeover bids under a different regulatory regime, one less hostile to mergers. But the Biden administration is the most anti-takeover presidency in modern history, and possibly all of history. Having studied antitrust closely since law school, that's actually a fairly easy statement for me to make. The smaller these companies are, the easier they are to buy. And you will absolutely get more deals if Trump wins the election. The big banks have hinted at the upcoming deal-making on their earnings calls with the rhetoric about how M&A is heating up on their very positive conference calls, and that can drive a stock market higher. Six, there's a recognition that if Trump wins, again, taxes, especially taxes for the wealthy, the people who mainly buy stocks, are going to come down. People want to get in ahead of that. Finally, seventh is about magnificence, or more accurately, less than magnificent. We're seeing a wholesale rout in big tech. These moments tend to be very self-fulfilling. People see a small cap rally. They know big money can be made potentially overnight. Some of that money, as I indicated, can come from the sidelines, but some is coming out of these big tech winners. I don't know if you could have this Russell 2000 rally without the ammunition provided by investors selling the big cap techs. Don't worry, the big cap techs aren't finished, but they might be paused until the small caps finish playing catch-up, which could take some time. The biggest takeaway from this incredible rally, there were so many charlatans who said that you have to wait for a broadening out before you can buy stocks. I said over and over again that the market doesn't give you that kind of chance. It just happens too quickly. The window for eclectic gains like this one, we've had it since last Thursday, is incredibly small. It doesn't stay open for long. And now the stock market is extremely overbought, much more than I like, and it's a dicier time to get in. Much dicier than a week ago. I'm going to make that point tomorrow at our Investor Club meeting. If you've been waiting for the market to broaden out, you most likely missed this mid-summer bounty. In the end, it doesn't matter if you think the rally is being caused by the possibility of a Trump presidency or the decline in inflation or the likelihood that the Fed will start cutting rates. What matters most is that unless you're invested all the time, instead of trading in and out and in and out, you'll miss these enormous moves. Bottom line. This shocking rally is why I abhor the relentless emphasis on traders. Believe me, those traders who left the market waiting for it to broaden out more, they are licking their wounds right now because they know they missed what could be the easiest money that has been made in years. The only way to profit from rallies like this one is to own the darn stocks ahead of time, if they spend so long out of favor. You can't just get in and get out back on a dime. Only true geniuses and liars can lay claim to staying out of small, medium-sized cap stocks for years and then jumping back in 4 business days ago. William in Michigan. William.
Hi, Jim. Thank you for taking my call.
Thank you for calling, William. What's taken?
With recent pressure on enterprise software stocks, as well as the recent security breaches for Snowflake, I would like your thoughts if you think the negativity is already priced in and if it's a good time to buy the stock.
You know, I thought, until I read more about the hack, I thought that maybe the negativity was priced in. But I have to tell you, the hack was a really bad one. And I say maybe you got to stay clear of Snowflake for a bit. I found it very curious, frankly. Let's go to Bo in Florida. Bo!
Madman, what's going on?
Not much. What's shaking with you?
I am curious. Retail sales look pretty good today, and I'm curious if you think it's time to start buying into Lululemon.
Oh, wow. Okay, Lululemon. Wow, this thing is so down. Now, we are so overbought. We are +8 on the S&P oscillator that I follow. I cannot countenance buying Lulu on that. But I will tell you, it seems like it has found finally a base at 282. By the way, I'll give you a 2 for RH, seemed to bottom today, too. But I don't want to plow in because of how overbought and too excited this market is. Let's go to Tommy, my home state, New Jersey. Tommy.
Hi, Jimmy. This is Tommy from Lafayette, New Jersey.
Lafayette. Love it. Love it.
Thank you for all you do for us.
Oh, you're quite welcome. What's going on?
My mentor. Listen, Meta has been having some crazy times. They're getting the analysts are screaming 600, 620, and the stock is dropping.
Well, look, it's had such a run. Okay, so listen, Tommy, here's my thinking. Meta's going to have to just mark some time. There's a July 29th meeting where Mark Zuckerberg is going to sit down with Jensen Huang, amazingly, in the same room. Can you believe it? But I think the stock marks time. It's had such a big run. It's up 38% for the year. Let's give it a little rest, okay? A little R&R on Meta. That's what's needed. The biggest takeaway I can give you from this rally is that you have to stay invested all the time. If you try and trade in and out all the time, you probably miss most of what is one of the most amazing moves of my lifetime. On Mad Money tonight, with earnings in full swing, I'm testing my thesis on two big banks that I think could keep running higher. Don't miss my deep dive on these firms. Then, diversification is a staple in Cramerica, so I'm going off the chart to see if a well-rounded portfolio is still the secret to success in the long term. And later, is Celsius losing its energy with consumers? I don't know. I had 6 of them this morning. I didn't mind at all. I'm talking to the data company 100X on some new research the company just published. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.